You know that feeling? That little sinking feeling in the pit of your stomach?
Mm-hmm.
You're looking at your portfolio, and on the surface, everything looks, incredible. The news is just screaming, AI supercycle. All your tech stocks are flashing green. The whole world is celebrating.
Right. It's party.
It's a party. But then you zoom out, you actually look at the trade logs, the 13F filings of the people who, built this market, and you realize the VIP section is empty.
Yeah. The people who threw the party, they're gone.
They didn't just leave. They quietly slipped out the back door while everyone else was still pouring a drink.
It is the classic retail trap, isn't it? We're all celebrating the arrival of the future, while the architects of that future are already heading for the exits.
And we are not talking about small trims here or just rebalancing. We are looking at a massive coordinated liquidation from the U.S. stock market's absolute darling. I went through the Q3 filings for the biggest American institutional investors, and it just stops you cold. Stanley Druckenmiller, Peter Thiel.
Two of the heaviest hitters on Wall Street.
Exactly. And they didn't just sell some Nvidia. They abandoned it.
Abandon is absolutely the right word. Druckenmiller's Duquesne family office sold every single share, a complete exit.
And Thiel's Founders Fund did the same thing right after.
Yep.
So that's the paradox we need to solve today. Why do you sell the winning lottery ticket while the numbers are still being called out? We're going to decode this smart money exodus happening in the U.S. markets.
And we need to understand why they left, but maybe more importantly, where did they move that massive pile of capital?
Exactly, because they didn't go to cash, they rotated.
And that's the key. This isn't a story about a market crash. It's a story about capital rotation.
Yeah.
It is a masterclass in separating a great company from a great investment.
Okay, so let's look at the crime scene, if you will. If you look at NVIDIA's performance leading up to these sales, the fundamental data was flawless.
Oh, it's perfect.
I'm looking at the earnings reports right here. Revenue up 94% year over year. Data center sales hitting $30.8 billion in a single quarter.
Unbelievable numbers.
And gross margins sitting at 74%. Those are software margins on a hardware product.
Yeah.
In any normal universe, you frame this report card on the wall, you don't shred it.
But the stock market isn't a report card of what you did, right? It's a betting slip on what you're going to do. The problem isn't that NVIDIA is failing. The problem is that it's priced for perfection.
The priced for perfection trap.
Think about the law of large numbers. Druckenmiller has been very vocal about this.
Yeah.
When you are a $2 trillion or a $3 trillion company, doubling your revenue isn't just difficult. It's mathematically almost impossible.
Right. To double from here, NVIDIA needs to add the equivalent of, the entire GDP of a mid-sized nation to its balance sheet every single year.
Exactly. And the market valuation assumed that was basically a guarantee. Just like that high-speed train analogy. Imagine the U.S. tech sector is a bullet train heading toward the AI future. The technology is real, the destination is real, but investors are popping champagne and acting like they've arrived at the station.
When the train is only halfway there.
Precisely. The stock price has sprinted 5 years ahead of the actual reality of the business.
And Druckenmiller's whole philosophy has always been about that timeline, right?
Yes. He said, AI might be a little overhyped now, but underhyped long term. And that sounds like a contradiction, but it's the entire key. The stock price in the short term has completely disconnected from the actual adoption curve.
It's a timing mismatch. You're paying a 2030 price for a 2025 reality. And that brings us to the valuation spread, which I think is the smoking gun here.
It absolutely is.
I was comparing the forward PE ratios, the price you pay for future earnings, at the time of the sale. Nvidia was trading north of 50 times earnings.
Which is just, that's a nosebleed valuation for a hardware company, no matter how good the chips are.
Right. But then you look at the other U.S. tech giants. Alphabet Google was trading around 27 times earnings. Meta was at 22 times.
That is a massive discrepancy.
It's huge. You're basically paying double for Nvidia compared to the companies that actually own the data and the models.
And that spread is the entire trade. This is what we mean by capital rotation. Druckenmiller and Thiel didn't bet against AI. They just looked at the menu. Why pay $50 for the shovel seller?
When you can buy the gold mine owners, Google and Meta, for half the price.
It's a value play disguised as a tech trade. And if you look at the 13F filings, that is exactly where the money went. Druckenmiller opened massive new positions in Alphabet and Meta. He literally swapped expensive AI for cheap AI.
And by doing that, he fundamentally alters his risk profile.
Oh, completely. This is the asymmetric risk concept. If AI slows down or if there's a supply chain hiccup, Nvidia has a very long way to fall from 50 times earnings.
But Meta at 22 times.
It has a floor. It's already priced more skeptically.
Yeah.
The downside is more limited.
And speaking of supply chain hiccups, that wasn't just some hypothetical risk, was it? The Blackwell chip launch delays were very real.
They were. And when you're priced to perfection, you cannot afford delays. Nvidia is currently only able to deliver, what, one chip for every 15 requested?
Yeah.
Now, you might say, that's great, high demand.
But in the hardware world, unfulfilled demand is really just an invitation for competition.
Exactly. Amazon, Google, Microsoft. These aren't just Nvidia's customers. They are its biggest threats. They are all designing their own internal chips now because they are tired of paying the Nvidia tax.
So the moat is slowly getting shallower, even if the revenue today looks amazing.
That's what the smart money sees. They see the moat shrinking and the valuation swelling, and they rotate.
But they didn't just move into software. There is another name in the filings that I found fascinating because it feels like the adult in the room trade.
Chuckles, yeah. TSMC.
Taiwan Semiconductor.
This is the infrastructure play. And honestly, it's one of the most logical moves in the entire portfolio.
Druckenmiller bought TSMC for 4 straight quarters. It's now his 5th largest holding, over 765,000 shares. This is not a dabble, this is high conviction.
Well, think about the logic. We just talked about this war brewing between Nvidia, AMD, and then the internal chips from Google and Amazon.
Yeah.
We don't really know who's going to win that design war in 5 years.
But we know who is going to build all of them.
Exactly. It's a monopoly play, basically. TSMC manufactures almost all of the advanced AI chips in the world.
Yeah.
It doesn't matter if Nvidia wins or loses market share. As long as the volume of AI chips keeps going up, TSMC gets paid.
It's the ultimate picks and shovels move. During the gold rush, you didn't bet on a specific miner. You bet on the guys selling the jeans and the shovels.
And the valuation difference is just stark. TSMC trades at a fraction of Nvidia's multiple. You get exposure to the exact same AI growth trend, but with significantly less volatility. It's the safe way to play a bubble.
Okay, so we have the cheap AI play with Google. We have the infrastructure monopoly with TSMC. But then I saw the outlier, the one that makes you, like, squint at the spreadsheet.
Laughs. I know where you're going. Teva Pharmaceuticals.
The generic drug maker. I mean, we're talking about the cutting edge of artificial intelligence, and suddenly we have a company known for generic painkillers. He bought nearly 16 million shares.
A massive position.
For something that has zero to do with tech, what is going on there?
This is where you see the difference between a wealthy investor and a legendary one. This is portfolio insurance.
Break that down. Why Teva?
Look at the macro environment in the U.S. You have a tech sector that is, overheating. You have valuations at historic highs. What happens if the music stops? What happens if the economy enters a recession?
Tech gets crushed.
Right. High-growth stocks get absolutely decimated.
Yeah.
So Druckenmiller buys Teva. It's a deep value stock. It trades at single-digit multiples. It's boring. It's unsexy.
But people need medicine whether the economy is booming or crashing.
It's completely uncorrelated. If the NASDAQ flushes 20%, Teva probably doesn't move, or it might even go up as investors flee to safety.
So he's barbelling his portfolio.
That's the perfect term for it. He has the high-growth AI plays on one side, and he has this massive, heavy anchor of defensive value on the other to keep the ship steady if a storm hits.
It really highlights how worried they might be of a broad market drawdown. You don't buy 16 million shares of a generic drug maker if you think the bull market is going to run forever.
It's a signal. He is preparing for a rotation where growth stocks stumble and value stocks shine. It's risk management 101 just scaled up to billions of dollars.
This brings up a historical parallel that I think we have to address. The sources mentioned the dot-com bubble of the late 90s, and I feel like every time tech stocks go up, people scream, "Dot-com bubble!" But is it actually different this time? I mean, Nvidia is making real money. Pets.com was not.
That is the single most dangerous misconception in investing. The dot-com bubble wasn't just about fake companies. It was about great companies with bad stock prices.
You mean like Amazon?
Amazon is the perfect example. In 1999, everyone knew the internet was the future. And they were right, Amazon won. But if you bought Amazon stock at the peak of the bubble in '99,
oh, you got crushed.
you lost over 90% of your money in the next 2 years.
Even though the company ultimately succeeded.
Even though the company changed the world. The NASDAQ Q as a whole dropped 78% from 2000 to 2002. A company can succeed while its stock price destroys its shareholders. That is the fear.
So Druckenmiller isn't saying Nvidia is a fraud. or that it's pets.com. He's saying Nvidia is Amazon in 1999, a true winner.
But one that is priced for a reality that just hasn't happened yet. Exactly. We are likely in the hype phase of this cycle. History shows us this pattern over and over with 3D printing, genomics, the internet.
You get this massive run-up.
And then reality sets in. Supply constraints, competition, regulation, the bubble deflates, the stock price crashes. And then slowly, over the next 10 or 15 years, the real sustainable value is built.
But the smart money isn't willing to stick around for that crash part.
Why would they? They just made their 1,000% return. Why risk giving half of it back just to try and squeeze out another 10%? The risk-reward ratio is completely flipped on them.
And that's what the retail investor, the average person listening to this, so often misses. We see the past performance and assume it's the future trajectory. We see a stock is up 1,000% and think, I need to get in.
While the institution sees the stock is up 1,000% and thinks, I need to get out.
FOMO drives the entry at the top.
And risk management drives the exit at the top. And unfortunately, if you look at the flow data, retail investors in the U.S. are currently providing the liquidity for these billionaires to sell. You are buying the shares they are dumping.
That is a very sobering thought. If you bought Nvidia in Q3 or Q4, you might have literally bought Stanley Druckenmiller's shares.
It is highly likely.
Okay, so let's synthesize this for everyone listening. We've covered the valuation gap, the rotation into Google and TSMC, and then this defensive hedge with Teva. If I'm a regular investor looking at this U.S. market drama, what is my takeaway? I shouldn't just panic, sell everything, right?
Well, no, of course not. Panic is never a strategy. The takeaway is to audit your ticket price. You need to understand why you own what you own.
Right. Are you holding it because the fundamental cash flows actually make sense at this price? Or are you just holding it because the line on the chart is going up?
If you're relying on the greater fool theory, the idea that you can just sell it to someone else for more than you paid, you are in very dangerous territory. The smart money has signaled that the easy money in this hardware trade is probably gone.
So they've moved on.
They've moved on
Yeah.
to the software application layer, to the infrastructure layer.
It's a shift from who makes the chips to who uses the chips to make money.
Precisely. The next phase of the AI trade isn't about the hardware, it's about the utility. And the valuations of those other companies reflect that.
It's just fascinating to watch the chessboard. While the crowd is chasing the king, the grandmasters are moving the pawns and the rooks into position for the endgame.
They are always thinking 3 moves ahead. And right now, their move is defensive growth.
So here's the final thought I want to leave you with. It is so easy to feel smart in a bull market. Everyone looks like a genius when the tide is rising. But the true test is what you do when that tide turns. When the next big technology wave hits, and it will ask yourself, are you the one trying to dig for gold in a crowded field with a million other desperate people, or are you the one quietly standing on the sidelines selling them the shovels?
That is the difference between getting rich and staying rich.
Keep digging deep. We'll see you on the next dive.